Good evening, everyone, and thank you for joining this CP session, PDM session on related party transactions. So the idea on bringing out a topic on related party transactions, as you all know, it's become very critical now. And the last major 2 or 3 audits which really hit the public eye has been on related party transactions and the lacuna in the audit in reporting these related party transactions. Of course, our focus here is twofold here. One aspect will be to sort of brief us or you could say refresh us and update us on the related party aspects that we need to be considering in our internal audit. And two is the practical challenges that we would normally is generally faced, especially in gathering data about related party per se and the related party transactions also. So moving on to the speaker, it's Mrs. Meenakshi Jayaraman, and she's currently the company secretary of Sify Technologies Limited. She has been company secretary for other major companies also, and in she's also held various leadership roles at Cognizant and then Chola of Murugappa Group, and then in Hinduja Leyland Finance and DBS. So in all these places, she has also led the corporate law and secretarial practice, and she's known for her expertise in corporate law. And she's also an active researcher and has also presented technical papers on company law and related subjects at various forums. She's also a regular speaker in the Institute of Company Secretaries of India. In terms of educational background, she's apart from being a company secretary, she also holds degrees in commerce and law. I have attended 1 or 2 of her sessions, and she's known for her clarity in conveying the concepts and also her grip on the legality of the matters. So, Meenakshi ma'am, a great welcome to you, and hope we have a very, very enlightening and an enriching session. Over to you, ma'am.
Thank you very much for those kind words. Good evening, everyone. It's indeed a great pleasure to be a part of this knowledge sharing session, and I would like to sincerely thank Mrs. Satyabama and Mr. Manoj Kumar Jain, because of whom I am here today as one of the speakers for one of the topics which is very close to my heart. And thank you so much. And I would also like to thank my colleagues who are here in Sify Technologies today to attend the session. And I would also like to thank all my past colleagues who have joined today for attending the session. And my sincere thanks to my colleague, Ms. Aishwarya, who has helped me to do this research work in contributing to this presentation. Thank you. We'll move on to today's topic, related party transactions, overview and challenges. First, let's understand why law requires specific compliances with regard to RPT. See, one, we all are aware that in order to protect the interest of all the stakeholders, SEBI has been imposing various regulations, of which RPT is one such stringent norm. In order to curb any undue advantage, what is that undue advantage? Primarily on account of conflict of interest. And when it is a transaction where it is on non-arm's length basis, then the issue arises where we call it as abuse of related party transactions, which means all transactions, when they are entered with related parties, they are not going to be considered as abusing the related party transaction per se. So let's start this session in a positive note. However, to ensure reasonable judgment, to enhance the transparency and disclosures, and to prevent the misappropriation of funds and diversion of resources, including the assets, and to avoid or prevent the conflict of interest amongst the related parties, we have various stringent norms, including the related party transaction, where we have specific transparency disclosure mechanism. We have the approval mechanism where the approval are like various structures, be it audit committee, board, shareholders, which we will look in detail today. But this is the reason why we have a specific compliance with regard to related party transaction. So today we will have the context set. In terms of overview, we will cover predominantly the corporate laws regulating RPT, where Companies Act prima facie applicable to all the entities, be it a private limited company, unlisted public company, or a listed entity. We are well aware that related party transaction is applicable, of course, with certain exemptions and privileges to private limited company. So today we will see what are the regulations which govern RPT transaction when it comes to all these corporate structures. From Companies Act, we will dive deep into sections 177, 188, read with Rule 6A and 15 of companies MBP rules, together with secretarial standards, which also prescribe how the disclosure of interest is mandated. We should always read 184 together with 188, because 184 talks about the disclosure of interest by the directors. Only when they disclose their interest or concern in various entities, the company will get to know which are the entities or which are the areas where the related party is getting triggered. So 184 acts as the basis for the company to start its activity on RPT. Then we will move on to listed entities framework, where SEBI LODR mandates the related party transactions, how audit committee shall approve all related party transactions, where it is giving the enhanced accountability and responsibility to independent directors as compared to your 177, where the audit committee is made responsible. Here, the onus is on the independent directors to approve the audit committee transactions when it comes to RPT. Regulation 23 is the charter provision which deals with this RPT transaction. Of course, we will read it along with the definition section, Regulation 2, subsection 1, and along with the various disclosures which are forming part of your Schedule 5, which drives the annual report disclosures. I am today going to deal more with Companies Act SEBI, given the fact that you all are well versed on the topic accounting standard. However, we will see what are the disclosures under AS 18, Ind AS 24 when it comes to RPT. Moving on, the first set of regulation governing RPT for the day, Companies Act. So we will discuss about section 2, subsection 76, which talks about the definition. And then we will talk about section 177, which drives the audit committee role, and 188, which is the fulcrum for related party transactions, are read with the rules, where 6A talks about your omnibus approval, and your rule 15, where in MBP rules, it deals with how the related party transactions you need to make the necessary disclosures and take necessary approvals from your board or shareholders, as the case may be. What is related party transaction? In common parlance, let us understand. It is a deal or arrangement between two parties who are joining hands for a pre-existing business relationship or a common interest. So the interest and the relationship, together with a combination of two parties, constitutes the RPT. So the principles of related party transactions. We saw in the previous slide the two parties is a prerequisite. And then the conflict of interest. We started the session by stating that why there is a law which mandates this RPT framework to avoid the conflict of interest. So the conflict of interest primarily to curb the misappropriation of assets, opportunities, or information for personal profits that may be available, for the reason being it is related. Then the third principle is to prevent fraud and any financial ruin for all the parties who are involved in that particular arrangement. And finally, we have the regulatory bodies, the oversight of all these regulators who ensure that this is barring the conflict that they have, and it is protecting the shareholders' value. So the principle is driven by the basic norms, where two thumb rules which we always ensure when it comes to related party transaction. One is OCB, the ordinary course of business. The other one is on an arm's length basis, ALM basis. So these two are the primary factors which we always see or check when any transaction between related parties occur in a company. So we will see in the subsequent slides about what is OCB and what is on an ALM basis to understand the fundamentals, right, before we move on to the deeper regulation and the other provisions. With prior approval and review. So what do you mean by prior approval? So the Act or the LODR regulation clearly mandates that the audit committee shall take a prior approval. That is, the independent directors, when it comes to listed entity, they shall make a prior approval for this particular RPT transaction, and it shall not be a post facto approval. And review, where the review arises is when there is omnibus approval. When there are repetitive transactions in nature, you take omnibus approval and review it on a quarterly basis. You review the approved vis-a-vis the actual numbers when it comes to audit committee. And disclosures, very important. So today we are going to discuss about what are the disclosures under your Companies Act, be it your both report or your disclosure under MBP1. And we will also look at your LODR regulation, where it is mandated that half-yearly disclosure shall be submitted by all these listed entities to the stock exchange. Moving on to the fundamentals. RP definition, related party, deals with 9 set of guidelines. When it comes to 9, it talks about individual. Individual includes your director, key managerial personnel or relative, and firm. So related party in relation to a company means it first set, you will, on the left hand side, you will have the company. On the right hand side, you will have the director, which means when there is a transaction between the company and a director, yes, it is a related party. How? Because 2 subsection 76, clause 1 talks about the director. Then comes KMP. So left hand side, you have company, right hand side, you have KMP or relatives. So when the relatives of directors KMP get involved in a transaction, then they also form part of your related party definition. Private company. Here, it says in which a director or manager or his relative is a member or director. So previously you had member and director. 2014, they came out with companies rectification of order rules, by virtue of which they said member or director. Public company, where you have a director or manager on one hand, and where a person is a director and holds more than 2%. So here also this rectification order rule came, where previously it was or. Then the companies made representation that when he is either a director or holds 2%, then squarely the companies were falling under this related party definition. To avoid that, the companies were provided this relaxation, whereby, say for instance, transaction is happening between a company which is X Limited, which is on the left hand side. On the right hand side, you have Y Limited, which is a public limited company. In this public limited company, A is a director. A is a director and he is holding, together with his relatives, 1.5% of the paid up share capital. Then they will not fall under this fourth bucket, because they are holding less than 2% together with his relatives. Whereas if he is holding more than 2%, say 3%, then automatically they will fall under the related party definition. Fifth point is like a dicey situation, where you have the board, managing director or manager is accustomed to act in accordance with the advice, directions or instructions of a director or manager. So accustomed to act, here where the problem arises, the challenge arises, to put it in sync with our topic today. When it is a direct hit, like 1 to 4, automatically you will do that acid test of left hand side, right hand side, and you will match the buckets. But when it comes to shadow director, as we call them, they are absentee directors, which means they are not in person in the company, but they will be holding the beneficial interest, or they will exercise significant influence, without whose advice or direction the company will not be functioning or they will not be taking any strategic decision, in which case they will be construed as related party. There was a Supreme Court judgment in Birla versus Lodha case where it was clearly evident, and Supreme Court also mentioned that the documentary evidence is very important, and such transactions are not one-off transactions, and the court or the judiciary authority will look at the consecutive transactions to assess whether this transaction warrants this particular person is providing the necessary advice directions to the company or not, in which case the related party definition will certainly get attracted. So accustomed to act is very, very important when it comes to shadow directors. Individual, a person except in professional capacity on whose advice or instruction the director or manager is accustomed to act. So here the previous one was a body corporate, with here it is an individual. So here except in professional capacity is a welcome carve out, because they say that when a person is providing his advice primarily in his professional capacity, then that will not be considered as a related party, which means all other provisions or all other advices directions provided which are in non-professional mode will certainly come under this related party definition. Then you have any body corporate, which is a holding subsidiary associate. Here is where most of the corporates will get attracted, where you have a company and the holding subsidiary associate company. We all are aware of a subsidiary company definition under 2 subsection 87, associate company definition under 2 subsection 7, where you have the investment of more than 20% or where they exercise significant influence. So we are not going to digress from the subject matter which is being discussed today. However, it's very important to note that in most of the corporates, they will come under this 7th bucket, where the transactions will frequently happen between the holding company, subsidiary company, or holding company, associate company, or between the company for which the transaction is being questioned and an investing company, say a JV company or a venturer company. However, this provision is not applicable to a private company, which means holding subsidiary, associate, fellow subsidiaries. They are carved out from this provision of related party definition under 2 subsection 76. Under Rule 3 of your company's specification of definition rules, they also introduce one more provision stating that a director other than ID or KMP of your holding company shall also be considered and included for the purpose of your related party list. For related party, it is imperative to know about your relative definition, because for director, KMP, and your firm, you are considering your relative. So who is a relative? 2 subsection 77, read with your Rule 4 of specification of definition rules, talks about who are all relatives. Members of Hindu undivided family, spouse, as may be prescribed as what is prescribed in your rule. Father, mother, including your stepfather, and your stepmother, son, including your stepson, son's wife, daughter, daughter's husband, brother, sister, including your stepbrother, stepsister. So this is a pictorial representation of what we have discussed till now. So where all these 8 points trigger your related party definition. So every time you have to watch out to see whether there is a transaction between the company and any of these 1 to 8 list of members to bring it under the fold of your related party transaction. So today we are going to discuss about 3 categories of RPT. One without board approval, the other one with board approval, and the third with shareholders approval. Without board approval, when the transaction is in the ordinary course of business and on an arm's length basis, then board approval is not required. Why? Section 188, read with your proviso in 188 subsection 1 clearly says that nothing in this subsection shall apply when the transaction is in the ordinary course of business and on an arm's length basis, which means the subsection 1 clearly talks about related party transactions where board approval is required, together with the proviso which talks about where it exceeds a threshold, which we will see in the future slides, shareholders approval is required. So the entire subsection, when they have granted exemption, it implies that when it is in OCB and ALM basis, the two thumb rules which we discussed in the beginning, then board approval is not required. However, please remember, 177 clearly says that, read with your rule 6A, clearly says that all transactions, related party transactions, shall be requiring audit committee approval, which means the transaction requires approval or subsequent modification. So whenever there is any subsequent modification, like your material modification as mentioned in your SEBI LODR. So any subsequent modifications also you need to go to audit committee. So let's be clear with this, with board approval. So anything which is not in ordinary course and which is not in ALM basis, then you have to take board approval. Specified transactions. What are those transactions where when it exceeds the threshold limit, shareholders approval is required? It is clearly specified in your 188 subsection 1, read with your rule 15. What are those transactions? Sale, purchase or supply of any goods or materials. Here it is directly assigned to the threshold limit where it says amounting to less than 10% of the turnover of the company. When it is sale or disposal or buying of property of any kind, there the threshold limit is 10% of the net worth of the company. Or leasing of property of any kind, it is 10% of turnover. Availing or rendering of any services directly or through an agent, then it is 10% of turnover. When it comes to office or place of profit, here they say related parties appointment to any office or place of profit in the company, which is the company in question, its subsidiary or associate. That is how 180 subsection 1 read with rule defines, which means holding company is not specified there, where the monthly remuneration exceeds 2,50,000. So this is the threshold for office or place of profit, similar to your 314 of your Companies Act 1956. Then you have underwriting the subscription of any securities, which is less than 1% of the net worth. So when it comes to this threshold, which is less than this limit, then you go to board, which means if it is exceeding this limit, you have to go to shareholders for approval. Previously, the section mandated a special resolution, then they have relaxed the provision. They said ordinary resolution would suffice the requirement. And for the computation purpose, you will take the amount with regard to the previous financial year. As mentioned earlier, audit committee approval is mandatory for all transactions. So that is the prima facie rule. Whether it is arm's length or ordinary course, you will not get into that. You will directly apply this audit committee approval route, because the terms of reference, when you read 177, it clearly says that the audit committee role shall inter alia include scrutiny of your intercorporate loans and investments, approval or any subsequent modification of related party transactions, approval of financial statements. So the terms of reference clearly defines RPT as one of the role of audit committee. Transaction where it exceeds the limit prescribed, it requires shareholders approval by way of ordinary resolution, which we discussed in the previous slide. So when there are members interested in the resolution, they shall not vote on the resolution. Imagine a private company. This is a challenge because you will have 2 members, 2 directors. So where will they go? Where will they go for approval? Thus, MCA relaxed this provision by stating that this non-participation of interested directors shall not apply to a private company, which means the related party can vote in such resolution where it is a related party contract or arrangement. Next comes 90% of more of the members are related. So there are companies where 90% or more of the members are related to promoters or related parties. Leave alone private company, even in a closely held public limited unlisted company. A member who is a related party can vote on such resolution which may be entered into by the company, even if the member is a related party. So there was a challenge. It was becoming a deadlock resolution without passing it because of the non-participation or for the related parties not voting in such resolution. So ministry considered in favor and they said that in those companies, there is a specific exemption granted. Then comes your 177 subsection 3 where it says ratification is allowed. So we saw in the previous slide about mandatory approval given by audit committee. So what will happen? There is a challenge because you're failing or you're omitting to take the approval. They say no worries, go and seek ratification, but within 3 months from the date on which the transaction occurred and not otherwise. So this is where the role of auditors will come, where the company has the routine internal audit on a quarterly basis, or they have the secretarial auditors or statutory auditors for limited review purpose. When such transactions get noticed by the management or by the auditors, how to streamline this transaction. So the act is providing this leeway. They say, go for ratification. And what if you fail to do? Then they say that, watch out, the director shall indemnify the company against any loss which is incurred by the company. The rule also adds another stipulation: the directors who are interested in the contract shall not be present at the meeting during discussion on the subject. So while I was reading what is interest, to see a couple of case laws, they say interest need not necessarily be your pecuniary interest. It could also be a personal interest. So the interest definition itself is very wide. So we need to every time check if the contract or arrangement falls within this particular ambit to go for related party approval. Finally, you have some blessing of exemptions. Of course, it is not applicable to many companies because only government companies, the transaction between two government companies, they have exempted this provision, which means 188 is not applicable for those companies. Shareholders approval, because the exemption clearly talks about shareholders approval. Transaction entered into between a holding company and its wholly owned subsidiary company whose accounts are consolidated. So which means you're already, the idea behind giving this exemption is you're consolidating the accounts and you're going to take the blessing of the shareholders when it comes to number of both the companies, and hence the related party disclosure will form part of your notes, and hence specific approval need not be obtained is the reason. And you have similar provision extended in your LODR regulation as well. Of course, we already saw the proviso to 188 clearly says that when the two thumb rules, you are going to meet the covenants of in OCB basis and on an arm's length, then RPT approval is not required both from the board and the shareholders. We've been discussing from the beginning about OCB ALM. Unfortunately, the challenge is you don't have any specific definition in the Act. If there is a definition, we will directly apply that on a case-to-case basis and see if it is falling within that ambit, and if it is falling, we will say yes, it is exempted. Unfortunately, the challenge happens that we don't have that provision. So what do? We will take reference from various cases, from various guidance notes issued by the professional bodies, and thus assess and derive at a conclusion whether it is on OCB basis or not. One such case is Bharti Televentures versus additional CIT, where they have clearly opined that MOA and AOA are not conclusive for deciding whether an activity is in the ordinary course of business or not. But it clearly shows that there is an intent to pursue those objects, because the MOA, especially the main objects, talk about what business activities you are going to pursue. So the frequency of the activity is mandated for verifying whether it is an OCB or not. So which means one-off activity, or you're doing it once in a blue moon, then that will not be considered as OCB. If it is going to be in recurring nature and on a continuous basis, then you will take it for the purpose of your OCB. There are few more guidances issued where they have taken reference from your UCC, Uniform Commercial Code of US, where they say OCB is defined as buyer in OCB with 4-part test. A buyer who buys goods in good faith, and he buys in the ordinary course of business from a person who is selling the goods, and even assuming that the seller is violating the norms, he is not having the ownership right, but the buyer is acting in good faith, believing that he is the true seller. And there could be this customary practice in such kind of business where the seller, in his usual practices, sells these goods, and in these 4-part test, they say that buyer in the ordinary course of business. So OCB thus is also having some essence defined in UCC, Uniform Commercial Code. In our guidance note issued by Institute of Company Secretaries of India, they have given a 10-pointer talking about OCB, what are the factors to be considered. One, MOA, which we already saw in the previous case law. This activity should be in furtherance of the business. So the repetitiveness is what is underlined here. Then the activity should be routine. We saw earlier, it should not be one-time activity, and it should be providing some benefit to your revenue stream, and your revenue generation, the bottom line should move up because of this, and you're deploying some resources for this particular mainstream of activity. So if all these factors have an affirmative answer, then you can certainly take that as OCB. The second thumb rule, which is ALM. ALM, fortunately, there is an explanation granted in 188. It says that when you are weighing a transaction between two related parties, you weigh that particular transaction in the light of a transaction which is happening as if they were unrelated, which means A and B. A is holding, B is subsidiary company. And when there is a corporate guarantee, generally when the banker is providing loan to a subsidiary, we have seen in practical experience that the bankers will go by the holding company's corporate guarantee assurance only, or a comfort letter, in which case the corporate guarantee, when it is granted, or if there is any other financial assistance provided by the holding company to subsidiary, what kind of transaction it is providing benefit if there are some unrelated parties. Intercorporate loan, for instance, if there is a holding company, subsidiary company, and subsidiary company is availing loan from this holding company, it's not only the loan rate of interest, because we know for sure that they will be providing the loan under section 186 rate of interest, because that clearly governs the provision. Specific provision is there. Hence, 188 will not get applied in that ICD, because 186, 185 takes care of your making loans, giving guarantee, providing securities. So having said that, let's understand this principle that if the rate of interest is going to be the same as you provide to a related party or unrelated party, that alone is not the driving factor. You should also see if the tenor of the loan is going to be 3 years. To unrelated party, the same 3-year tenor should also apply for a related party. If that being the case, then you are exempted from this transaction to seek board approval and shareholders approval. Thus, the second point, that is what I'm trying to emphasize. It is not the price alone which is the driving factor here. You need to see the transaction in a complete framework to see not only the price, all other terms and conditions. So the bundle of the transaction should be the driving factor to assess whether the transaction is on an arm's length basis or not. Unfortunately, the challenge is 188 is not prescribing the methodology how you will calculate ALM. Thus, each company adopts its different yardstick to calculate and arrive at a fact that yes, this is on an ALM basis. There is one case law substantiating this particular ALM transaction where Filtrex, in the case of Filtrex versus ACIT, they say the ITAT held that the acceptance of arm's length price declared by one party cannot preclude the revenue from determining at length the transaction from the other side, which means they have every authority to look at the transaction in detail from the other party's angle as well, though it is the same transaction. Under Income Tax Act, you have the arm's length price being determined when it comes to your domestic transfer pricing or your international transfer pricing. Various methodologies are prescribed. Maybe we can take a cue out of that to assess the transaction on an ALM basis. Couple of them are your comparable uncontrolled price method, your resale price method, cost plus method, profit split method, TNM method, and any other method as may be prescribed. So the thumb rule again is OCB ALM. Just to take a review of what we have studied till now, if you are going to fall within these two ambits, then board approval, shareholders approval is not required. Needless to say that audit committee approval is certainly required because 177 does not provide any such exemption. However, if there are such transactions where there is specific exemption granted to a private company, to a Section 8 company, where for Section 8 company, the 2015 notification clearly mentioned that a person who is interested in such transaction where the value is not exceeding 1 crore, then they need not seek approval. And you have specified IFSC public companies, government companies, for all of them. You have separate set of notifications issued during the years 2015 for all these companies. For IFSC companies to fall within these notifications, then you are exempted. Otherwise, you have to go for audit committee approval, followed by which you have board approval when it is OCB ALM, and when it is OCB ALM with specified threshold as prescribed in your Rule 15, then you have to seek shareholders approval by way of an ordinary resolution. So it's the challenge is how you will prove that the conflict of interest is not there. So you have to critically review the terms and conditions. You have to see not only the price. We saw that the bundle of that particular transaction has to be seen in a comprehensive manner, which includes your quality, quantity, and such other terms and conditions. Moving on to your 188 subsection 1, which talks about your office or place of profit. So what is office or place of profit? Any office of profit which brings to the person holding it some financial gain, advantage, or benefit. That is office of profit. But when there is a financial advantage together with a remuneration or benefit, then it could be an office or place of profit. So office or place of profit, in the explanation to this section, they have provided two categories. One such category is where office is held by a director. So if a director is holding that particular office and he receives some remuneration over and above what is already enshrined to him as a director, in the capacity as a director, it could be salary, fee, commission, perks. So over and above that, if you are providing him anything, then it triggers the office or place of profit. The second category is where office is held by a person other than a director, in which case all these components, be it remuneration, salary, perquisite, whatever it is, which is received by this individual or which is received by any firm or body corporate, that triggers the office or place of profit. In the guidance note on RPT issued by ICSI, they say if there is a remuneration given to a director, it will not be considered to be an office or place of profit. They say it will be on an ALM basis for the simple reason that you already take approval under 197 read with Schedule 5, which deals with the remuneration to your full-time director or your managing director. Similar to your provision for your intercorporate loans or corporate guarantee, where they say when there is a specific provision which governs 185, 186 for such transactions, then 188 need not apply. Of course, it is a guidance note which we always can exercise the cautious approach of going to the board and shareholders. When it comes to one-person company, always there is a benefit available to one-person company. So they should not be screwed under these provisions. Thus, they have granted this condition to be satisfied for one-person company because you have only one director who is setting the tone. So the contract shall be in writing. It shall form part of your minutes, and the activity should be as enshrined in your charter document. These conditions are not applicable when the contracts are entered in the ordinary course, which means if it is not in OCB, then you will take the necessary approval by entering it in the meeting, in the minutes of this meeting of the board. And this shall also be filed with the registrar within 15 days. Though it is not practically applicable to all these companies, we need to be aware of this legislative principle. Moving on to omnibus approval. So AC has the authority to set the criteria for granting omnibus approval after obtaining the necessary approvals. So the criteria which could be defined by the audit committee are: what will be the maximum value of RPT transaction in total? And in case of individual transaction, what will be the maximum value of transaction allowed? And how frequently the audit committee will review such RPTs when they are approved, which means on a quarterly basis. Generally, all the companies, they take it as an agenda item every quarter. If you are going to take a conservative view of doing it on a bi-monthly basis, then your policy document or your RPT framework guideline should clearly mention that you want to review, because there are frequent transactions and hence you want to review it on a bi-monthly basis. So transactions also should be carved out if you don't want to bring them under this omnibus approval if they are non-repetitive in nature. So you will consider these factors when you are going to, when I say you, it is audit committee. When audit committee is granting omnibus approval, repetitiveness of the transaction, be it past or in future, and what is the need for bringing such transactions as omnibus approval, and why do you want to bring them out of the shelter of a specific consent to be obtained from the board? Why are you bringing them as under one yardstick of a general approval route? So AC shall satisfy the need of bringing them under this omnibus approval shelter. And you should always remember that this approval is valid only for one financial year, which means in all the companies, before your April meeting, you should ideally, with your internal audit plan approval or your business plan in the month of March, you should have the omnibus approval for April to March approved. And the value is also prescribed. They say this approval could be granted by audit committee for a value not exceeding 1 crore. While you provide this omnibus approval, you shall specify who are the parties. When it is holding company, subsidiary company, who are the parties involved in the transaction. Say, for instance, if it is going to be for a lease arrangement, you will say the nature of the transaction is lease arrangement. The duration is, if it is for 3 years and there is a lease sharing space between the holding and subsidiary, you will say 3 years as the duration of the transaction. And maximum amount. What will be the maximum amount of lease rental for the next 3 years? So you have to factor the escalation of rent also into consideration, and the indicative base price, which means you will do a valuation report and you will assess in the market based on the geographical location what is the base price which is being set here and how you have arrived at that particular value. And if the audit committee requires any other additional information for granting this approval, you shall certainly provide. Omnibus approval is not relevant when it comes to selling or disposing of the undertaking of the company. Again, the reason is you have a specific provision 181A where you're going to route it through the board and the shareholders, and hence it is not forming part of your omnibus approval. Similar to the earlier slide which we discussed, the ratification, you have 3 months. And what if a director fails to make the necessary disclosures and there is a contravening act of such arrangement, then he shall indemnify the company for any loss which is being occurred. The guidance note issued by ICSI also provides exemption or relaxation when it comes to issue of shares. The rationale behind this particular issue of shares falling outside the ambit of related party transaction could be because you're already taking specific approvals. When it is preferential issue of shares, you are taking approval under both 42 read with 62 of your Companies Act read with your 14 and Rule 13 of company share capital, and where you also have the necessity of obtaining the registered valuer's report together with various other approvals prescribed therein. Likewise, your ESOPs are well governed under your 62(1)B read with your Rule 12. Your sweat equity is also governed by a specific provision. Hence, they have carved out all these specific instances. Otherwise, it leads to multiple approvals for the same transaction. However, they have mentioned transfer of shares could be considered as a related party transaction. Again, professionals, please remember these are only guidance notes issued by ICSI. So if there are certain transactions where you would still feel the need for taking specific approvals to take another valuation to assess that there is no conflict of interest in such transactions, when there is issue of shares to a promoter, you might as well follow the normal route of taking the necessary approvals of audit committee, board, shareholders, rather than going to the regulator to justify that this transaction is outside the ambit. We are moving to the second bucket of today's session, SEBI LODR regulations. In the meantime, I'll be glad to take your questions under Companies Act, or we can move on to SEBI LODR regulations. Okay, we'll get on to SEBI LODR. Finally, after completing this, if you have any questions, I'll be glad to take it. Like your 177, 188 for Companies Act, you have only one regulation, Reg 23. However, there is a challenge because Regulation 23 itself has undergone multiple iterations, and there are various representations made by the companies, and after which the regulator has provided certain relaxations in the recent amendment. When I say recent amendment, we are drawing reference to 12th December 2024 notification given by SEBI, where they have provided certain relaxations when it comes to the definition of related party transaction. However, it is certainly a point to be worth mention that this regulation 23 is stringent, because every time when there is a transaction, you have to check whether it is falling within that Reg 23, whether you have made necessary reportings, and including your disclosures. When it comes to disclosure, be it your half-yearly disclosure or your annual report disclosure. Let's first understand the definition of related party and related party transaction. 21ZB talks about who are related parties. The definition is extremely wide because they are not restricting it to only Companies Act. They say all the applicable accounting standards, meaning your Ind AS 24 and AS 18 are also applicable when it comes to SEBI LODR as applicable to your organization. Deemed related party. Deemed related party, they say any person or entity who is belonging to a promoter or promoter group, or any person or entity who is holding equity shares of 10% or more, whether it is directly or indirectly, which means the promoters are covered, and those who are holding, previously the provision was 20%. Now they have reduced and they are making the ambit further wide by bringing it to 10%. So when your shareholding is 10% or more, the point to be noted here is directly or indirectly. That is very important. So if you have filed your 89, your BEN forms declaring that you are a beneficial holder, that also to be reckoned for the purpose of arriving at a conclusion whether you are a related party or not. In LODR, you will see in several instances, units of mutual funds are exempted, and this is no exception. RPT, transfer of resources, services, or obligation. The definition lifted from your accounting standards, but it is not stopping there. It is extending to your subsidiaries. That is where the challenge is. Not only the transaction of your listed entity. It says, even if there is a transaction of listed entity or any of its subsidiaries on one hand, and a related party of the listed entity or any of its subsidiaries on the other hand, which means 4 such permutations are applicable in this instant case. Listed entity, say A Limited with its related party. 2, listed entity A Limited with any of its subsidiaries, be it B, C, who are its subsidiaries, or B is a subsidiary. So B with the related party of your listed entity. So need not be a related party of your subsidiary is what we need to remember here. And B being a subsidiary with any of its related parties on the subsidiary. So all the points are well covered here. The second one is very wide. Here they say the listed entity or any of its subsidiaries on the one hand, and any other person, the purpose and effect of which is to benefit a real related party. Here the intent and the purpose has to be same. So when you read one case, I was wondering to see what is the purpose and effect. So there again, in one of the cases, R10 versus CIT, they have clearly mentioned when there is an intended purpose, it relates to an effect. When there is an effect, it leads to intended purpose, which means both are going hand in hand. So if the real benefit, say for instance, A is an airline company and B is another company which is a subsidiary of this particular airline company, and C is the company with which there is a transaction. So A and C are entering into a transaction. B is nowhere connected, but C is providing a subcontracting arrangement to honor the obligation of the transaction between A and C. B, though there is no direct contract provided by A to B, but C is providing this. The purpose and effect of this is to benefit B, which is a related party of A. So you have to check all those criteria also to see if the related party benefit is extended to your subsidiary or your associate company. Here, it's very important to connect the transactions because they say it is not a single transaction. The group of transactions should be reckoned. Of course, they have provided the exclusion list. You can relate it to your guidance note issued by ICSI, where I was mentioning about your preferential issue, where it is specifically governed under your 6242 of Companies Act. Thus, here for listed entities, they say you have a specific chapter assigned for preferential issue, which is ICDR chapter 5. So if you have that chapter being governed for these companies, you have a separate set of valuation and all the rigorous exercise, and hence you need not go for RPT approval. And the second point, corporate action for dividend, your subdivision, consolidation, your rights issue, bonus issue, buyback, in all such corporate action events, they say the RPT is excluded. The same provisions are available in your guidance note as well. But one thing which you have to remember here is the word within brackets, which is mentioned over there, uniformly offered. So it should not be a benefit provided only to your promoter shareholders or those who are related to your company. It should be extended to all shareholders, in which case you are taking this benefit under RPT exclusion. Buyback, again, you have this rigorous exercise of valuation and your other guidelines, and hence they have brought it outside this purview. Similarly, for banks, NBFCs, acceptance of deposit is in their ordinary course. Hence, they have carved out this provision. However, they say that specific RPT disclosure is required. While I was mentioning about this 12th December 2024 notification, they have granted additional relaxations. They say when there is acceptance of current account and savings account deposit by banks. However, it should be in consonance with your RBI directions. Then it is exempted. The other one is retail purchases from any listed entity for the manufacturing of goods. You require any raw material, you are purchasing that. Such purchase by the directors without establishing a business relationship at terms uniformly applicable. So when it is going to be on an arm's length basis, such retail purchase which is going to be fostering your business growth, then it is exempted. What are the rationale for bringing all these exclusions, especially these amended provisions? Mainly to simplify the compliance for the banks, because already they are under the regulatory radar. To when it is commonly applicable to all public. Why should you penalize the related party? 3, as long as there is a disclosure. We saw in the previous slide about RPT, half-yearly disclosure. When there is a disclosure, why do you penalize the related parties? Moving on, 23, sub-regulation 2 talks about your audit committee approval procedure. All RPTs and any subsequent material modification. This subsequent material modification again is a challenge, because what is subsequent material modification is a $1 million question. I went through a couple of top listed entities to see what is the threshold they have prescribed. They say that if you have obtained an approval today and there is a modification during the course of the year, they are linking it to the original approval as the benchmark and say if it is going to exceed 250 crore or 10% of the previously approved number, whichever is lower or higher as per the threshold prescribed by various top listed companies, because each company has fixed its own yardstick. Few of them have said 250 or 10%. Few companies have mentioned 25%. As long as SEBI does not question you with a specific earmarked number, then you have the free will to prescribe the threshold, but you need to convince your audit committee, because you're independent directors, unlike your Companies Act where the audit committee is going to approve. Here your independent directors are going to approve the transaction as mentioned in point 3 of my slide. You will define this in the document which is called the policy on RPT. Prior approval required. When will you take a prior approval? RPT to which a subsidiary is a party, but listed entity is not a party, which means it is extending. Again, here it is a challenge. It is not restricting the scope only to the listed entity. Even when your subsidiary is a party to the transaction, then the threshold is prescribed, where they say the value of such transaction entered individually or taken together with all your previous transactions exceed 10% of your standalone annual turnover, then it warrants your audit committee prior approval. When is it not required? RPT to which a listed subsidiary is a party, but listed entity is not a party. I will give you one illustration to understand this better. A, listed entity. B, subsidiary, listed entity. B, listed entity, subsidiary. You need to take approval if you're not falling under LODR provisions. But the 10 crore, 25 crore paid up capital net worth, or as set out in your regulation 15. So if you are falling within that limit and you are complying with your LODR provisions, then no point in again going to your regulator or coming through this particular journey of various approvals. They say you are relaxed, provided you follow the corporate governance provisions prescribed in your Schedule 4. This is a recent addition, 6.7 and 6.7. So they say remuneration and sitting fees paid to directors shall not require approval. You can relate it to your guidance note on ICSI, where they have clearly mentioned as long as you comply with your 197 provision on Schedule 5, don't come to us because you are taking a specific approval. Similarly, they say AC approval is not required, provided they are not your promoter or promoter group, and as long as it does not exceed your materiality threshold. What is materiality threshold? We will be seeing it in the subsequent slides, because the shareholders' approval warrants this related party transaction when there is a material RPT. So we will see what is the threshold prescribed. Ratification of RPT, you can relate this to your Rule 6A, similar to that related party transaction. However, the main difference is, as I mentioned earlier, here ID's approval is required. So you should not go to your EDs or NEDs. You will take approval from your IDs, and 1 crore, it should be consecutive, repetitive, all those within 3 months ratification, all remain the same. And the voidable indemnity provision also is lifted from your Companies Act. So if you are not taking approval, don't worry. Within 3 months, you take it ratified, and also it will not be illegal. Please remember this word illegal. This challenge is minimized by saying that it is voidable at the option of audit committee. And however, the company, if it is going to incur a loss, your director shall indemnify, retaining the language under your Companies Act. Omnibus approval, similar to your provisions under Rule 6A, audit committee has the authority to prescribe the criteria. They shall satisfy whether it is warranted to come under this omnibus or should you go to your specific approval route. When it is specific approval, friends, please remember, no general consent is allowed when it comes to RPT. I wanted to tell during our first category discussing about Companies Act, which means you cannot take all related party transactions, unlike your omnibus approval, to the board or shareholders. For each transaction, you need specific approval. So specific consent is required. That is one point to be remembered. Another point is Section 188 clearly starts by saying that at a meeting of the board. Again, these are procedural, but since when it comes to review mechanism, I thought it would be useful for you to understand that it cannot be passed by way of circulation. Like your 179 subsection 3, where at a meeting is warranted, here again at a meeting is warranted. 1 year, fresh approval is required next year. All the provisions are the same. Prior approval of shareholders. Please remember this word, prior. So post facto approval, as scored off in the earlier provisions, here again, they clearly mandate the prior approval from your shareholders. When it comes to material transactions or material modification, which we discussed in the previous slide. So subsequent material modifications like the 250 crore adopted by the top 10 listed entities. Very important to remember that no related party shall vote to approve such transaction. Please appreciate the difference here. Unlike your rule 15, sub rule 2, where they say, if I am a related party in the transaction where I am concerned under Companies Act, I should not participate. Here they say, whether it is related to your transaction or not, when it comes to RPT, you better don't give your vote. So no related party shall vote on such resolution, whether the entity is related to that particular transaction or not. When is shareholder approval not required? For audit committee also, we saw the provision of A being a listed entity, B subsidiary being a listed entity, and B complying with the corporate governance set of provisions from your regulation 15 to your schedule 4 regulation. If they are complying with that, then your subsidiary, for the transaction entered by your listed subsidiary, you need not take a specific approval. Of course, for a company which is under IBC, provided you make necessary disclosure to stock exchange within 1 day of approving your resolution plan. This is one interesting slide. Finally, we have something which is called non-applicability of these stringent provisions. Previously, the transaction between two government companies, after this 12th December notification, they have modified it as two public sector companies. And when there is a transaction between a holding and wholly owned subsidiary company, it is exempted, provided the consolidation happens. This is well in alignment with your Companies Act provisions. They've also added transaction between two wholly owned subsidiary companies. Of course, your holding company should certainly do the consolidation and it should be placed before your shareholders for approval. With the recent amendment in December 2024, they've added few more points to give relaxation, more for ease of doing business. When there is a payment of statutory dues or statutory charges being paid to the government or regulator, then such transaction will not trigger the related party. And of course, all these benefits are more to the public sector companies, government companies. Nevertheless, they've added the transaction between the public sector and the central government or state government. Policy on RPT, the materiality threshold, which I was mentioning to you, where it warrants the shareholders' approval. It is nothing but 1,000 crore or 10% of your annual standalone turnover. Previously, it was consolidated. Then they modified it as standalone. So here it is, when it is 1,000 crore or 10% threshold prescribed, then you have to take the materiality. You will pass the materiality test and you need to go to shareholders for approval. For brand usage or royalty, the threshold that they have prescribed is 5% of annual consolidated turnover. They have enhanced the limit from 2 to 5% here. Policy on RPT should talk about your materiality threshold, your material modification and subsequent material modification as mentioned earlier. And very important, you need to disseminate this policy on dealing with RPT on your website. So your Reg 46 clearly deals with which are the policies which you have to host it on the website. One such important policy is your policy on RPT. And very important point to be noted is once in every 3 years, you have to review this policy. Just to have a quick snapshot of what we have discussed thus far, audit committee or related party transactions and material modification, you need to take this specific approval from audit committee. Omnibus approval for the transactions entered by the listed entity or the subsidiary. We saw the ceiling limit also earlier. The board of directors, regulation 4 clearly says that monitoring and managing the conflict of interest is crucial, and thus board cannot escape their role of having this related party transaction maintained sacrosanct. Shareholders. When it comes to shareholders, we saw that all material RPTs and material modifications, you have to take their specific approval. And when it comes to material transaction, we saw just now the threshold of 1,000 crore or 10%. And exemptions, we saw about the transaction entered between wholly owned subsidiary companies, or when it comes to two wholly owned subsidiary companies, then the transaction is squarely outside the ambit. Moving on, Secretarial standards is the third category which we are discussing today. Secretarial standard with regard to meetings of the board, here it clearly talks about where you can attend, where you cannot attend, and when you should disclose, within how many days you should disclose, in what form you should disclose. And very important, when chairman is interested in such transaction, he shall not participate in the meeting. He shall give the authority to someone to act as pro tem chairman, and the non-interested director shall act on his behalf. And once that particular related party transaction gets completed, the chairman can resume the chair. And another important point is, it shall not be passed by circulation, which I've already mentioned. It is emphasized in your secretarial standards as well. And the disclosures, 184(2) disclosures, when it clearly provides the evidence that the director is interested in a contract, then he shall not be present at the meeting at the time of discussion of such item. SS1 deals with your board meeting disclosures. SS2 deals with your general meeting. So general meeting also, they want the related party to abstain from voting. Then they say related party not entitled to vote in a resolution in which he is a related party will not be reckoned for the purpose of your quorum. And when it comes to public companies, chairman is not entitled to propose a resolution in which he is interested. He is not entitled to conduct the proceedings for that item in which he is interested, and conduct of the proceedings shall happen through a disinterested director. He shall resume the chair only after that item is discussed. Similar to your board meeting SS1, which we discussed just now. In the year 2022, RBI also realized that when MCA is coming out with such challenges of stringent norms for RPT, when SEBI LODR is being made more and more stringent with additional disclosure framework and approval framework, why not we? Thus, in April 2022, we had additional disclosures stipulated for the scale-based regulatory framework, which was introduced by RBI, where they said whether you're a base layer, middle layer, upper layer, that is different story. You bring the additional disclosures of your RPT. Of course, like the annual report format for NBFCs, which was clearly prescribed and mandated by them in the SBR regulation, they have added the provision for RPT framework also. Thus, separate disclosure is warranted for directors and relators of directors. Previously, the annual report disclosure contained only for KMPs and relators. They said that we need a separate disclosure for directors and their relators. And they wanted a separate transaction disclosure for RP where it exceeds 5%. And this SBR framework, they broadened the related party definition as is defined in Companies Act by including trust and other bodies where these NBFCs would exercise significant influence. Thus, it is imperative for us to note that this SBR framework has brought into its effect all the NBFCs, whether it is listed or unlisted, and all the layers, widening the scope of related party transaction. we are moving to the final leg of today's webinar, which is disclosures and audit. So we will see what are the disclosures required when it comes to Companies Act, SEBI LODR, and AS 18 Ind AS 24. KMP disclosure. Director and the KMP shall ensure that the notice of any related party transaction is delivered well in advance to the audit committee and the board. How will they do that? Under 184(1), it is stipulated that they have to provide a prescribed form when they are appointed as director or KMP. They have to provide the details of their various relatives and the related parties in this prescribed form. They have to make it as detailed as possible. I always tell my students that make this MBP1 more customized so that you can lift the related party directly from this MBP1. Thus, it is significant for us to make this form as comprehensive as possible so that the 188 automatically gets lifted from this 184 and you are able to assess whether the transaction is related party or not. The form is actually not filed with ROC and hence you can amend the form. You can make it as elaborate as possible. And it is also significant for us to note the fact that when a director or KMP is not going to disclose this properly, this directly leads to vacation of office of a director under 167. Unlike your 188 violation. When it comes to 188 violation, you have a penalty provision there. And you also have 164 provision which deals with disqualification of a director. After this 188 non-compliance, he gets disqualified. So he can always prove, settle that, remediate that particular default and come on board. Whereas 184, if you are not going to act on it, then directly the vacation of office of a director comes into picture. Thus, it is important for disclosing the concern or interest of a director or KMP. There are 3 scenarios where this disclosure will happen. 1, when you get appointed. 2, whenever there is a change. 3, at the first board meeting of every financial year, which means April or May. When there is a meeting, it is important for you to obtain this disclosure. Specific disclosure. 184(2) requires director to disclose his direct or indirect concern or interest in any proposed contract or arrangement to be entered into with a body corporate in which he individually or with other directors hold more than 2%. Thus, in MBP1 form, if you see, just like a one-pager plain vanilla form, you will not be having all those minute details. You get the details of PAN, put it in your software to throw up an alert that PAN, or if it is a holding subsidiary, have the SIN mandated. If your software is going to throw up the alert that yes, there is a transaction, there was a purchase between this holding company and subsidiary company. Of course, for subsidiary or associate, you will get to know because you will work in cohesive manner within your department. But how will the auditors know? For your internal auditor or your statutory auditor to know whether this transaction is well within the RPT framework, it is useful if the software has this alert mechanism where you get the details in your MBP1. So that acts as the base for you to obtain the details as much as possible, be it a body corporate or firm, or where he is acting in any other capacity, leave alone a directorship. If he is going to act as a promoter manager of that body corporate or in any other firm or entity, that will be disclosed in his MBP and you will feed it in your software so that will throw an alert and your auditor will be convinced that there are no such transactions which are related party in nature, and hence whatever approval mechanism the company has, whatever the disclosure mechanism they have are in order. As mentioned earlier, they will not participate in the discussion during the meeting if they are interested. And if the transaction occurs, subsequently, I become a director in one such corporate, no worries. In the next board meeting, you disclose it and substantiate that particular disclosure in the form of MBP1. The registers to be maintained. you will enter this RPT detail in the register of contracts, which is maintained under 189. Again, for 189, the trigger point is you should come under 184 too, where your shareholding together in the interest in the body corporate together with any other director is exceeding 2%, or 188, where it is not in the ordinary course or arm's length basis. Then 189, you will register the particular entry and you will take the signature from all the directors. You, needless to say, that you will place it in the board meeting. When it comes to related party transaction, the agenda shall clearly state the related party name, the contract duration, and if it is going to be a material contract, we saw what is material as the thresholds prescribed under your Rule 15, or when it comes to a listed entity, that 1,000 crore or 10% turnover, and whatever is the pricing mechanism that you have arrived at under your arm's length method, you will disclose what kind of methodology you have adopted and any other information which facilitates your board to arrive at a decision. The notice shall again contain the material facts, which also includes your monetary value, other information which is relevant for your members to approve. The board's report. The board's report 134 should clearly talk about your RPT disclosures. Always the students ask me this question. When through thumb rules, that is ordinary course arm's length basis, are fulfilled, am I required to disclose in the board's report? Answer is no, because the form itself is designed in such a way that when it is not on an arm's length basis, you will fill. That is part 1. If you go to part 2 of the form, it will clearly talk about material RPT. We know what is material RPT because Rule 15 has clearly provided us the threshold. So if the material RPT is together with an ALM, then you will disclose, which means both the parts you have to see only if it fulfills the norms. There is no point in doing a voluntary disclosure. Only when it arises, you will disclose. And you should also provide the need for entering into such contract or arrangement so that your investors are aware of this background. SEBI LODR disclosures. We are done with the first leg. When it comes to SEBI LODR, the RPT policy, you should disclose on the website. Provide a web link in the annual report so that your investors can be benefited by reading it. Half-yearly disclosures. Half-yearly disclosures, previously they said, provided November 2021, you had this provision of half-yearly disclosure. They said, give it within 15 days. Now they say nothing doing. Along with your financial results, you publish the half-yearly disclosure also. I'm sure many of you would have read the half-yearly disclosure format. The half-yearly disclosure format itself is pretty detailed. It talks about the various related party transactions, and it also talks about the opening balance, closing balance, and hence the FAQ was also released by SEBI, which is put as a footnote in the disclosure now, stating that even if there are no transactions, anyways, you will have the opening closing balance of each such transaction. So you need to report, and it is a continuous reporting mechanism. Provide this disclosure, whatever you have filed with stock exchange on the website, and the disclosure requirements as prescribed for your annual report. While your annual report has your corporate governance, MD&A, your other shareholders information, include the RPT disclosures as well. What are they? That 34, read with your Rule 53, talks about the annual report disclosures regarding the person who is belonging to the promoter or promoter group, which holds the relevant shareholding in the listed entity. You have to provide that particular disclosure. And where there are materially significant related party transactions, you will provide those disclosures. And this 8 and 9 are recently added provisions in alignment to your remuneration sitting fee provision, which was discussed earlier. They say the remuneration and sitting fees paid to directors KMP is not required to be reported in your half-yearly disclosure if they are not material. And this particular exemption is not provided when it comes to the payment of remuneration to your directors KMP who are forming part of your promoter group, because they say the rationale behind including this exemption mechanism for not reporting your remuneration is already you're reporting your remuneration under 197 subsection 12, because in the case of listed entity, they are talking about your median remuneration disclosure, all other disclosures in your board's report. That is taken care. Not only that, in your annual report and annual return also, you're going to talk about your remuneration to directors. To avoid duplication, they said that this half-yearly disclosure is not warranted. AS 18, you have this disclosure of holding subsidiary, fellow subsidiary, associate, KMP, relatives of KMP, and in total, all the transactions are well covered here. So you will provide for each such category of companies the names and the description of the relationship that you have with them. In Ind AS 24, you have the RPT disclosure, which talks about the transaction amount, the outstanding balance, and provision for doubtful debts, and where there is expense recognized during the period in respect of bad and doubtful debt, you have to provide it separately for each category, for parent, subsidiary, joint venture, associates likewise. And these entities shall disclose the relationship inter se between the related party entities that you have disclosed, and entities shall disclose the KMP compensation. Unlike your key managerial personnel, both in AS 18 and AS 24, you have a reference to key management personnel. So you need to see the definition and apply that particular yardstick for various benefits that are extended to these KMPs, be it a short-term, post-employment or other long-term benefits, termination benefits, and your share-based payment. So your ESOPs, sweat equity, everything will get covered under this fold. Audits, we will see what is the role of your statutory auditor, secretarial auditor, cost auditor, internal auditor in brief. So statutory auditor, when it comes to financial reporting framework, it requires adequate disclosure, primarily to ensure that it is avoiding the conflict of interest. And SA 550 also deals with what are the responsibilities cast on the auditor when it comes to related party transaction, and what are the assurances or the documentary evidence that the auditor will vouch for. He will rely on the third party confirmation. He will see the minutes of the meetings of the shareholders and those charged with governance. It could be all other committee meetings, primarily your audit committee to deal with the related party, and any other document that warrants the circumstances of this particular related party transaction in nature. Your secretarial auditor has to report in his prescribed form MR3, which also includes a specific clause about confirming the compliance with related party transaction. Not only that, your LODR regulation 24A clearly deals with the secretarial compliance report to be issued, which deals with the compliance for related party transactions. And here again, the secretarial auditor will look at all the audit evidences, including the third party confirmations, to rely on the related party framework adopted by the company. The cost auditor, your cost audit record rules clearly talks about the items of cost in the books of accounts, which deals with also RPT transactions. Here again, like your Income Tax Act, where the arm's length methodology is prescribed, they determine the normal price of RPTs basis the various methodologies as prescribed thereunder, and the details of RPTs with each product service per se, you have to provide it in item number 5 of part D of your cost audit report. Moving on to internal auditors, your SIA 18 deals with related parties, similar to your AS 18. Here, the related party activities of the entity, you have to ensure that they are properly captured through adequate internal controls that are established, and whatever deficiencies that you have detected, you have to give those suggestions for improvement to the management. Not only that, the internal auditor shall perform adequate internal audit procedures to obtain information for evaluating the internal controls associated with such related party transaction. Again, for internal auditor, what are the reliances based on which he is going to affirm on the related party compliance? He will look at the identity of these related party transactions, the nature of relationship that is established between these entities, and the purpose of the transaction. The intent will also be looked into. The documentary evidence, he will look at again the third party confirmations, the minutes of the meeting, and other records or documents. Here there is a big list provided under SIA 18. They say your income tax return, your shareholders register, your statement of conflict of interest with regard to the entity's investments, the contracts and arrangements with all your key management, specific invoices which deal with such related party arrangements, policies, contracts, and other documents associated with the entity's filing with the respective regulators. So all these transactions will be taken into consideration for the indication of the related party transactions, whether they are existing or not. We will conclude with few interesting case studies where we will see what are the concerns or challenges and how the regulator has been stringent while it comes to RPT framework which is adopted. We all are aware of ILNF crisis, where one of the pitfall was the RPT abuse. Here, ILNF has defaulted on the huge debt. The transactions between the related parties were not adequately disclosed by this entity, and RPT framework was critically reviewed. They said that approval process was not in place and transparency was missing, which led to the ultimate systemic financial risk in this organization. This is another interesting case where PwC had resigned from the auditor's role. They said that they were not able to analyze the impact of the financial support extended by the company. The transaction is this. There were ICDs in Eveready and corporate guarantee which were issued. But the details of this particular transaction were not adequately disclosed. They had a reason. The Eveready's reason for this particular inadequate disclosure was they said that in the event of default by these companies, ideally the subsidiaries or associates to whom they were lending the support in terms of corporate guarantee and ICD. They said that in the event of default or for payment of dues, this particular deposit or guarantee will be invoked upon, and hence adequate evidence was not provided. But this was the concern highlighted by PwC, and they said that there was not adequate evidence for this particular related party transaction which was done by this Eveready company, and they had submitted their resignation. Of course, subsequently, they had appointed Singhi & Co. as statutory auditors. In Sun Pharmaceuticals Limited, there was this alleged violation of certain provisions related to RPT in this company, and the settlement was reached with the market regulator in Feb 2021 without admission of denial of guilt. The alleged violation included your non-approval by board and shareholders for consecutive years from 15 to 18. Thus, Ministry of Corporate Affairs levied penalty for non-disclosure and for not obtaining necessary approvals when it comes to related party transactions. In Linde India Limited, there were certain agreements entered between this Linde and Praxair. Praxair, as the name goes, is a global merger emerged out of Praxair Inc. So this transaction was consequent to this particular global merger. So the irregularity was this. In respect of a business agreement entered between these two parties, they had the product and geographical allocation handled. The company had the view that this product allocation or geographical allocation will not form part of any of the business dealings, and hence they said that it is outside the ambit of RPT. But SEBI held the view that the allocation of future business or opportunities is also synonymous to transfer of assets, and hence it warranted the RPT scrutiny is the message conveyed by SEBI, and they also subjected the company to have the necessary valuation done by appointing a registered valuer to carry out the valuation of the business foregone and declare the necessary results to the regulator. When there are gray areas and challenges like this, where the companies always have a question of doubt, be it a fact or legally, whether this particular transaction triggers RPT or not, they seek SEBI's informal guidance, of course, by following the necessary procedures and payment of prescribed fee. One such instance is infra debt, which is an NBFC. Here, I had mentioned in my earlier slides that when you are a relative and you are related party to the transaction, the Companies Act says that you will not participate in the voting of such transaction. There was a practical challenge here. In this NBFC, all the corporate shareholders were the related parties. the exemption, they had quoted this exemption provided by the Companies Act, where it says related parties will be allowed to vote on RPTs in case where 90% or more of the members are relatives of the promoters. They asked this informal guidance from SEBI whether it can be applied in this case. Since there is a practical challenge, the company is not able to take the necessary approvals, for the reason being all the related parties are the corporate shareholders. SEBI provided a response stating that existing and prospective transactions would require shareholders' approval, which is very clearly mentioned in your Reg 23. They also added that no related party shall vote on the resolution because 23(4) says that whether you are a related party on the transaction or not, you should not vote on that resolution. However, they said that you can refer to this provision in your explanation to 15(1)(a), where it says comply or explain basis for high value debt listed entities. When there is this comply or explain, you provide this reason. Explain that there is a practical challenge in implementing this, and you also disclose the reason for non-compliance in your corporate governance report, quarterly compliance, which is provided under your Reg 27. However, friends, please note that after this 12th December 2024, this reporting of quarterly compliance is no longer in vogue, for the simple reason that SEBI wanted to dispense with all the duplication of filings, since RPT disclosure is already provided in a detailed manner in your Reg 23 Sub-Regulation 9. In NTPC, there was a query, multi-year agreement. So they said that already they have sought approval for the related party transaction from the shareholders in the year 2015. Whether it is still valid or not. SEBI clearly stated that nothing doing. Every year you take an approval. Just like how your omnibus approval you take every year. They quoted the circular 8th April 2022, where they said that shareholders' approval obtained for RPT will be valid from one AGM till the conclusion of next AGM. So they said that your 2015 is no longer valid. You need to take specific approval every year. Here, NTPC again asked this question, whether approval of audit committee is required for transaction between a listed entity and the related parties where government nominee directors are appointed. They very clearly mentioned that the exemption is granted only for a transaction between two government companies. And here the transaction is between an entity which is listed and a related party who is a government nominee director, and hence the exemption is not available in the instant case, and thus you need to go for approval. Another query from NTPC, which is very significant for us to note, as I was mentioning earlier, the guidance note on ICSI. They asked this question whether we can rely on all these guidance notes issued by the professional bodies. SEBI clearly said that as long as it is in alignment with your LODR, you go by that. If something is contradictory to the provision enshrined in LODR, then we will not go by the guidance. You have to go only by the mantra provided in your LODR regulation. That any guidance issued by ICSI or any other authority which is conflicting with the provisions set out in LODR are not relevant for granting exemption. So with this, we are concluding today's session. Thank you very much for joining in such large number despite being a weekend. And I would like to again thank all the participants, my colleagues, Satyabama ma'am and Manoj for giving me this wonderful opportunity. Thank you.
Ma'am, thank you for a very 360-degree view of the RPT. Any of the members have any questions specifically? You can actually either put on chat now, or there is a Q&A thing. You can either put on that or we can ask directly.
Yeah, Mr. Sainath, I will share the presentation. We'll certainly do that. Yeah, somebody has asked about the cost of non-compliance. Very pertinent question. The cost of non-compliance in case of listed entities and unlisted entities, they have clearly provided under 188. They say it is 5 lakhs for unlisted entities, and for listed entities, the cost is very severe. It is 25 lakhs. Not only that, there is a saving grace. You have this adjudication provision under 454. Since it is only a penal mechanism, you can go for adjudication. One, the adjudication will provide you the relief of setting the default right. So you can remediate that particular default, or otherwise the penalty will be imposed. For the penalty which is imposed, you need to stick to the limitation period within which you need to make the payment. If you don't make the payment, then not only the penal consequences, the Act clearly says, Companies Act to be precise, it also talks about your imprisonment for a term of 6 months.
So the compounding provisions in certain cases are present. No, those things all will not apply here because it's a pure penal provision and stops there.
Correct,
okay.
ma'am. So you can go under the adjudication mechanism.
Okay. Okay. Any other question? I think no, nothing more. Thank you. What was very interesting was three things in the presentation. One was the audit angle, which you covered, and where you brought in the various roles or the expectations rather of the various auditors. So that was something that is not usually covered in such a topical presentation here. That was very, I mean, we know some things, but we also know what to ask again. So that was a very enlightening part. And then the last one about specific case laws and where the interpretation matters were given, that was also very enlightening. And it's a very complex topic. I think we still have challenges in terms when you talked about, role of internal auditor and all that. At least the statutory auditors, they have the option of exiting, resigning, but I think internal auditors, we carry a much larger burden in terms of ensuring or telling the management on appraising the management on the risks of non-compliance or what has gone wrong in the transaction. And we are also again primarily we have a very major responsibility, especially in terms of fraud risk again. And so I think the onus on internal auditors sometimes they feel is much more than compared to other auditor categories. I think it's much more onus here. And increasingly, I mean, in spite of having secretarial compliance, I also see a trend of corporates asking internal auditors to include secretarial compliance as part of the internal audit, which again becomes a major challenge because we need to keep so much updated about the laws, especially in a dynamic environment where there are rules and notifications coming on a daily basis.
Completely agree, because I see a lot of internal auditors asking me about various provisions. When I used to wonder why then they tell me that there are a lot of additional roles which are enshrined to them in terms of secretarial compliance. So I see that these days coming up.
Yeah, because especially compliance risk is something very, it's becoming a big, very, very big. It has become already a very, very big onus on all the corporates. And so they are, they want to always ensure that there is a double, a one check, single check, double check, three checks, whatever, to ensure that they don't, they are not hit by a ball, especially in terms of compliance. Penalty, huge penalty, and the compounding effect, thankfully it's not here. But we are also subject to now NFRA. So the role or scrutiny of NFRA on internal auditors is again, I mean, they did pull up the internal auditors of ILFS, but and there is also a feeling among the internal auditors community on whether NFRA should have jurisdiction over the internal auditors. But that aside, that is also a big regulatory risk that we are also facing in terms of practice, whether you're in an internal auditor inside the corporate or outside as a practitioner. So that is the complex environment. And again, the data challenges are still very huge. And identifying, if you fail to identify what is your experience, ma'am, especially in large corporates where the volume of transactions are also very high? In case, I mean, we again to a large extent seem to be depending upon voluntary disclosure by the management at various levels. So, but how do we even identify, apart from that, what do you think can be done to ensure the better identification and compliance as far as RPT is concerned?
Yeah, very valid point, ma'am. Actually, I was actually wanting to convey this point of disclosures being very stringent and transparent. One, the challenge is when you ask directors to provide their PAN numbers, the first question they ask is, why do you need my PAN number? And my PAN number can be provided. Why are you asking for my relatives, extended relatives PAN number, which they will not be willing to share? So that will be the originating point of making your disclosures very, very comprehensive. And the second point is the policy of your related party or the SOP guidelines, the framework mechanism that you have in the company should be very, very comprehensive, not restricting the scope to what is said in the regulation or the Companies Act, making it as elaborate as possible so that it does not leave room for any interpretation issue in future. That is point number 2. Point number 3 is the software that you're going to build in your company, especially in large corporates. What they do is they build all this particular disclosures, whatever they receive from the directors or the KMPs or whoever is the related party in their Oracle or in the relevant software to throw alert for any such transaction, and you need to maintain those audit trails. So the focal point for these transactions should be the finance team, the secretarial team in terms of collecting all these relevant documents and keeping the evidence, because when your auditor wants to do such particular check, he is not doing it to throw an observation or comment. He is wanting to support the management to ensure that they are well in compliance with the RPT framework. So you need to support them by providing all these additional mechanisms that you have in terms of your software system or in terms of the documentary evidence that you have. And when in doubt, it is better that you assume that it is an RPT transaction and you go for valuation. Even if there is an exemption provided, or even if you are very clear that it fulfills your thumb rule of OCB and arm's length, it's always better when it comes to your related party transaction, you take that particular benchmark, which is the to prove the fact that when it is an unrelated party transaction, the invoice value would have been the same. So maintain that when for build that particular audit trail, so that that will act as the guiding force for the management and also the auditors. So that is what I wanted to tell.
Thank you, ma'am. Unless there are any other questions, yes, there is. So for a private limited company where 197 is not applicable, remuneration will still not fall under 188. That's a query.
Yeah, for a private limited company, yes, you're right. 197 is not applicable. The remuneration will fall under the provision of your office or place of profit. So again, office or place of profit, you have to go by that explanation, two bifurcations. For a director, they say that any remuneration other than the remuneration which he is getting in the form of or in his capacity as a director, be it a salary perquisite, they are out of this particular coverage, which means that remuneration you have to squarely apply under explanation sub rule 1, whether this director is taking the remuneration in his capacity as a director in the form of salary, perquisite, allowances. If yes, then it will not fall under 188. If not, it will come under your office or place of profit. Trust I have answered your question, Charanya.
Okay, we'll move to the next question, ma'am. This is asked by Mr. Selvakumar. We are having two entities and we are doing purchase transactions between the company. Both companies' directors are same. Example, A is private limited and B is LLP firm. LLP purchases goods in some other person and sells the product to that private limited company. Can we get any approval? So it's basically between an LLP and a private limited company.
Correct. See, when you read the definition, 2 subsection 76, it talks about in relation to a company, which is on the left-hand side, any firm, director, KMP, relative, third point is your firm. But LLP is not a firm. Then you go down, further down to see 5 and 6. whether it will fall under body corporate. Because if you read definition under LLP Act, it says LLP means a body corporate. So a body corporate, but firm is not LLP. However, if you read that body corporate, if you are that body corporate is accustomed to act in accordance with the directions. So if you fall within that particular ambit, that shadow director, the absentee director, which I was explaining in the beginning, if you fall under that ambit, then LLP is a related party. Otherwise, LLP is not a related party as far as Companies Act is concerned. But having said that, there are few articles which clearly accept the fact that LLP is not a related party. But under Ind AS 24, LLP is considered to be a related party. So the necessary disclosures for your financial statement, you need to take care.
Oh, okay.
It's a gray area because LLP is not a firm.
Okay. I don't think we have any more questions. So I think with that, we can wrap up the session. And any other questions others can have, you're free to contact ma'am. Yeah. So we can direct the queries to us and we can send it, or you can also send it directly to her.
Anytime, anything related to company corporate laws, please feel free to approach me. I'll be glad to share my number along with the presentation with ma'am. You can contact me, reach me anytime. Thank you so much.
Thanks a lot for your time and a very insightful session, ma'am.
Thank you very much.
A pleasure to have you. Thank you, ma'am. Bye.
Thank you very much. Thank you. Bye.